Okay. Anyways, did you know that Disney's stock has lost over 50% of its value from its 2021 peak? A shocking number for a company synonymous with childhood magic and global entertainment dominance. It was once soaring above $200 in early 2021, but it now finds itself hovering below $90. That's a jaw-dropping 55% decrease for a company that has long been considered a blue-chip stock. For nearly a century, Disney has dominated the realms of entertainment, theme parks, and merchandise. But this dramatic decline begs the question: what went wrong? Is this just a bump in the road for a company that has always been synonymous with innovation? Or is it a sign of deeper structural issues? More importantly, could this downturn present a golden opportunity for investors willing to bet on Disney's future? Stick around as we dissect every angle of Disney's current challenges, its strengths, and its potential comeback strategy. Whether you're already a Disney shareholder or just considering an investment, this analysis will help you make an informed decision. The problem: Disney struggles in a changing landscape. To understand Disney's recent slump, we have to look at the challenges it's facing from multiple fronts. 1. The streaming wars are draining resources. When Disney Plus launched in November 2019, it was a game changer. With a massive library of beloved content, including Marvel, Star Wars, Pixar, and classic Disney films, it quickly became the fastest-growing streaming service in history. Within 16 months, Disney Plus had surpassed 100 million subscribers. But fast forward to 2024, and the streaming landscape has drastically changed. While Disney Plus has over 150 million subscribers globally, when combined with Hulu and ESPN Plus, profitability remains elusive. In fiscal 2023, Disney's streaming division reported operating losses of $4 billion. The competition is fiercer than ever. Netflix is leading the pack with its ad-supported plans and global dominance, while Amazon Prime Video is leveraging its e-commerce ecosystem to fund original content. Even newer players like Apple TV Plus are making waves with award-winning shows. Disney's strategy to chase subscriber growth at all costs is no longer sustainable. Investors want to see profitability, not just user numbers. Disney is now experimenting with price hikes, ad-supported plans, and tighter spending, but it remains to be seen if these measures will pay off. 2. Theme parks. Rising costs and changing demographics. Disney's theme parks have always been crown jewels in its portfolio, contributing nearly $30 billion annually. But these parks are also capital-intensive operations, and recent years have exposed their vulnerabilities. The pandemic dealt a massive blow to park revenues, and although attendance has largely recovered, operating costs have soared. Labor shortages, inflation, and new construction projects have made it harder to maintain the profitability that parks once enjoyed. On top of that, consumer habits are changing. Many families are opting for less expensive vacation options, and younger generations are spending more on experiences outside traditional theme parks. While Disney is trying to adapt by introducing immersive premium experiences like Star Wars, Galactic Star Cruiser, these initiatives have received mixed reviews and aren't accessible to everyone. 3. Content fatigue and franchise overload. Disney's dominance in the box office has long been fueled by powerhouse franchises like Marvel and Star Wars. But even the most beloved IPs aren't immune to fatigue. Take Marvel, for instance. The Marvel Cinematic Universe, MCU, was once an unstoppable force, with films like Avengers: Endgame grossing over $2.7 billion globally. But more recent releases like Eternals and Ant-Man and the Wasp, Quantumania, have underperformed both critically and commercially. The same can be said for Star Wars, where oversaturation and divisive content have alienated some fans. Disney's live-action remakes of animated classics such as The Lion King and Aladdin were initially huge hits. But as the novelty wears off, these projects are starting to feel repetitive, leaving audiences craving something new. 4th, macroeconomic pressures. Beyond its internal struggles, Disney is also contending with external factors. Rising interest rates and fears of a global recession have dampened consumer spending, especially on discretionary items like streaming services and theme park vacations. The broader stock market has also been volatile, with investors favoring more defensive sectors over consumer-focused companies like Disney. Disney's strengths: a diversified revenue machine. Despite these challenges, Disney's diverse business model remains its greatest asset. Let's take a closer look at the key pillars of its empire. 1. Theme parks and resorts. Disney's parks are more than just attractions. They're immersive worlds where nostalgia and innovation collide. From Star Wars, Galaxy's Edge to Avengers Campus, Disney continues to push the boundaries of what a theme park can be. Even with rising costs, parks remain a significant revenue generator. Disney has also been investing in international markets, with expansions in Shanghai and Tokyo poised to attract millions of visitors annually. What's remarkable is how Disney monetizes every aspect of the park experience. For instance, the merchandise tied to specific attractions often generates as much revenue as ticket sales. Think about it. Every pair of Mickey ears sold at $30 is almost pure profit. 2. Streaming services. Disney Plus might be struggling with profitability, but it's a long-term play. The platform's vast library of content gives it a competitive edge, especially for families. And let's not forget Hulu and ESPN Plus, which cater to different demographics and expand Disney's reach. To address its streaming challenges, Disney is exploring new revenue streams. For example, it's experimenting with ad-supported plans and bundling its services to provide more value to subscribers. If executed well, these strategies could turn streaming into a reliable profit center. 3. Box office and content. While Disney has faced some content fatigue, it still dominates the global box office. Hits like Avatar, The Way of Water, and Frozen 2 demonstrate that when Disney delivers, it delivers big. Disney is also sitting on a treasure trove of intellectual property, from Marvel and Pixar to National Geographic. These brands give the company endless opportunities for cross-platform storytelling, merchandise, and experiences. 4. Merchandise and licensing. Here's a part of Disney's empire that doesn't get enough attention: merchandise and licensing. From toys and apparel to home goods, Disney-branded products are everywhere. In 2022 alone, Disney's licensed merchandise generated $50 billion globally. Even during tough economic times, the demand for Disney products remains strong, making this a reliable revenue stream. Key developments and future plans. What's next for Disney? Here are some of the major moves the company's making to turn things around. 1. Bob Iger's return. Disney's board brought back Bob Iger as CEO, signaling a return to the fundamentals. Under Iger's leadership, Disney has announced plans to cut costs, focus on profitability, and streamline operations. His track record of successful acquisitions, like Marvel, Pixar, and Lucasfilm, has investors hopeful that he can steer the ship back on course. 2. Content licensing. In a surprising shift, Disney is considering licensing some of its content to rival platforms like Netflix. While this may seem counterintuitive, it's a smart move to generate short-term cash flow while maintaining ownership of its IP. 3. Technological innovation. Disney is heavily investing in AI and other technologies to improve efficiency. From AI-driven content creation to personalized park experiences, these innovations could significantly enhance Disney's offerings and bottom line. 4. Focus on quality over quantity. Disney has pledged to scale back on lower-performing projects and focus on event-level content, blockbusters, and series that drive massive engagement. This shift could help restore consumer confidence in its brands. Investor takeaways. So, is Disney a good investment right now? Here's the summary. Disney is facing significant challenges, but its strengths and strategic initiatives suggest a potential turnaround. Its diversified revenue streams, unparalleled brand power, and focus on innovation make it a resilient company. For long-term investors, Disney's current stock price could represent an attractive entry point. However, it's essential to monitor key developments, especially in streaming profitability and theme park performance. Now, what do you think? Is Disney stock a golden opportunity, or is it too risky? Drop your thoughts in the comments. I'd love to hear from you. And if you're enjoying these stock breakdowns, hit that subscribe button and stay tuned for the next videos. Bye.